lot over lockdown.
Yeah. So thank you very much again for everybody for taking the time out today as well. Now, if I can hand you over to Dipesh Bhai. I think Dipesh Bhai, if you go through your slides, if there's any questions, if we take them at the end. If you want to use the chat to post questions, by all means do so, or you can ask questions afterwards, after the slides as well. Please try and make sure your videos or sound is on mute so that you can just hear Dipesh Bhai, and then we'll get everybody to unmute once he's over, and you can ask questions. Jai Shri Krishna, everybody. Thank you, Dipesh.
Okay, Kamlesh Bhai, just one other comment I was going to make. We're recording this session, so if you don't want to be recorded, then obviously you can drop off. A recording of this will be made available on the SBA Prajapati website afterwards. So obviously I just wanted to make you aware of that. And I guess if you want to post any feedback on the chat or questions on the chat, you can do that as well.
Thank you. Over to you, Dipesh Bhai.
Thank you, Kamlesh. So welcome to today's presentation, The Changing World of Retirement Planning. Now, I know sometimes when people think about retirement planning, they think it's a long way to go. We don't need to do anything right now. But the problem with that is the years soon disappear. So although it seems like a long time, it's actually not that many years to go. So some of us will be closer to retirement. Some of us will still have a few years, and some will have quite a few years to go to retirement. The key thing with this presentation today is really to encourage you with regards to some of the things that you should be thinking about from the beginning. So we know that retirement planning, we know that the world is changing. It's one of the most important topics in the world of financial planning. We know that the reasons are simple. However, the challenges in good retirement planning are quite complex. So just a quick introduction. My name is Dipesh Shah. My company is called Oakdale Financial Services Ltd, and we're a partner practice of St. James's Place Wealth Management, which is a FTSE 100 company. So key thing is, when we're looking at retirement planning, key things that we should always consider is in terms of making sure that we've got a goal, we plan accordingly, and we also take the appropriate action. So if you think back to the beginning of this year, seems a long time ago, considering we're coming up now to the end of this year. But if you think back to the beginning of this year, quite a lot has happened this year. And in some ways, this year has been unusual from a number of different points. So when the year started, the main things that were dominating the news were things like global interest rate concerns, of course, global interest rate, inflation rates as well. So inflation rates have been very high for the last year. It's around about 10%. So that has a massive impact on your money. Of course, there was the situation, Russia, Ukraine, that led to more shortages. It led to price hikes in energy, toppled up with inflation. It's been an expensive year from that point of view. From a cost of living point of view, it's become more expensive. Investments, we have seen a lot of investments over the last 1 year, whether you've invested in property, equities, fixed interest, gilts. A lot of these things have fallen during the last year. So this particular year, from an investment point of view, has created more challenges, and therefore it's important to have more advice on a regular basis. So the key thing that we're thinking about is that the key thing is planning. The more emphasis should be on planning rather than the actual retirement part. So key thing is, we need to identify your goals, look at the challenges that will stop you, and then put in a structured plan that will help you to meet these objectives. And this is the value of advice. So now, normally with pensions, of course, engagement is going to be critical, because usually when we come across pensions and retirement planning, the natural reaction looks something like this. People tend to put their heads in the sand. They tend to think it's a long time to go. And the problem is, the longer you leave it, the worse it's going to be, the harder it's going to be to have the type of retirement you want. So key thing we would say to all of our clients is, retirement seems a long time away, but of course it's not a long time. The years will soon disappear, and what you do now will have a major impact on what's going to happen in terms of the future. Now, obviously, conversations around pensions should be a lot more animated than what we've seen on the previous slide. Maybe not this excited, but the key thing is, pensions are an incredibly tax efficient way to help you build a flexible financial strategy. And this is really going to help you to meet your needs and requirements in retirement. So question here is, why plan for your retirement? We know that in simple terms, we're all different in terms of our requirements, and we know that the state support has been reducing over the number of years. Therefore, it's more and more important that people put in place their own personal planning to reduce reliance and dependence on the state. So let's take a look back in history at the good old days in 1970s. So what happened then was, individuals had a retirement age. So you would work, the retirement age was normally around about 60 or 65. You had a choice of tax-free cash or an annuity. There was no such thing as enhancements at that time. And the life expectancy was till the mid to late 70s. So you can clearly see what's happened here. People used to have a single, so they'd work for the same employer for the majority of their working career. Now, of course, that's very unusual, almost unheard of, to work for the same employer throughout one's working career. If people used to work to 60, 65 and life expectancy was 70, you'd spend an awful long time working, but the amount of time that you'd have available to enjoy the money would be actually a very short time. So if you think about this as a system, it's a great system. It's very sustainable. You've got lots of people paying in for lots of years, and then they only need that income for a few years. So it was a very, very good system. Obviously, such a system like that would not be able to last like that forever. Now, here what we're saying is longevity should be celebrated. We know that people are living longer and longer. However, the problem from the state pension point of view is, and also from a personal pension point of view, is that the fact that people are living longer, they're in great health, and they're often living for decades. Now, this has a major impact on the amount of money you're going to need in retirement, how you should look at how your investments, your retirement portfolio has been structured, and you need to make sure that you've got enough money for a long retirement. Because if you live a long time, then if you're in good health as well, then you're going to need access to more money to be able to have the retirement that you've worked all these years so hard for. So what we're looking here is, with factoring into your plan's longevity. Longevity should not be underestimated. Life expectancy is increasing. More and more people, young people, are living longer and longer. And this is both for males and females. So what this is showing you, probably no surprises here, but it shows you that the average age of females is higher than the average age for males. So females, women will tend to live longer than men. Now, living beyond 100 will soon be the norm. It's not going to be unusual. So we know that a lot of newborn babies can expect to live to 100 or 100 plus. However, over the next the data from the Office of National Statistics says that the average life expectancy soon for all newborns will be approaching 100. So of course, this creates challenges in terms of how long you live, how long you've got to work for, how long you're going to live, how much pension pot you need to be able to save, and how much the value should be. If you're going to be living longer, you're going to need a larger pension pot, especially when you take into account things like inflation, interest rates. Interest rates have been very low for a very long time. Now, if you just leave your money in a bank account, then that money is not necessarily going to grow. And over a long period of time, one, you're losing out because of low rates of interest, but two, you're also losing out because of high rates of inflation, which will reduce your purchasing power of money in the future. So really important that we take into account longevity. The data is showing that we're all living longer, therefore we need to take action earlier. The longer we leave it, the harder it will be to recover the situation. So let's have a look at the situation with regards to millennials seeking more pension support. So we know that 24% of millennials don't have a pension at the moment. Now that's quite a high number, especially when you think that the government has introduced auto enrollment to encourage people to save for their pensions. We know that 27% don't believe that pensions are relevant to their generation. However, they might be thinking about the old type pensions. The new pensions are very attractive because of the changes that have taken place. We know that 66% of people have been auto-enrolled for workplace pension schemes. Ideally, that figure should be higher. If you have an option for a workplace scheme, you should certainly consider joining that one as an initial course of action. 23% say that their current workplace or personal pension contribution is inadequate. So if they're saying it's inadequate now, and if they carry on saving and investing the way they're investing, then no surprises, in the future it's going to continue to be inadequate. They have to make sure that they're maximizing pension opportunities, i.e. pension contributions, tax relief, growth, compounding. You have to think about all of these factors. 28% do not feel confident with money or financial matters. So a lot of them are unsure about financial instruments, financial vehicles. And 37% they are saying they're saving as much as they can, but still do not think it is enough for a comfortable retirement. So key thing is, people probably need to be saving more for retirement to make sure that you've got enough resources for the longer life. So what it shows is, although there's a lot of support and a lot more guidance around pensions, people still don't take pensions as seriously as they should do. People don't find out this bit of these types of information. And remember, we are there if anyone wants to find out about these things, how their pension is going to be impacted. Then these are things that people need to consider as part of an overall retirement planning background. Yeah. So let's have a look at what the world is now looking like in 2020 and beyond. It's going to be a very different type of world to what it was historically. So nowadays there's no retirement age. Employers cannot make you retire. So as long as you're fit and healthy, you can continue to work. Some people will continue to work because they enjoy the work they do. Some people will continue to work because they want to make sure that they can leave a good legacy for their family, spouses, children. And some people will work just purely to keep their mind and body active as well. So certainly people will work longer, and then also some people will just have no choice because of various factors that have taken place in the years up to retirement. Maybe they haven't built up sufficient retirement funds. They haven't invested in other types of assets that will give you the retirement income. So some people will just have to work longer. Unfortunately, there may not be a choice there. We know that there's a demise of final salary scheme. So Final salary schemes or defined benefits are the gold standard of pension schemes. So a lot of companies, because of the cost involved to the scheme, have been closing these schemes down. So if you've got a final salary, what you might have seen in recent times, the value may have gone up because interest rates, inflation were low. If you got a value last year and you've got a value this year, you'd probably find that the value has decreased, because as interest rates go up, as inflation goes up, it's all going to reduce the value of final salary schemes. Now, with final salary schemes, the great thing about them is that they offer you certain guaranteed benefits. So the benefits will increase in line with inflation, and usually they would provide a spouse pension of 50%. But sometimes people don't really need those benefits. So in some cases, it may be possible to look at some different type of planning, which involves moving a final salary pension into a DC, defined contribution. Obviously, it has to make sense, and there has to be a number of things in place, but some people are looking into that as an option. But of course, it's not going to be right for all people. So if you need a fixed income, then of course a final salary pension is going to be a great solution. But for other people that require a bit more flexibility, then there are other options out there. There's an amazing amount of choice, and with choice, sometimes you think choice is good. Sometimes too much choice is actually not a good thing. It makes things incredibly more complex, and therefore you need the right advice at the right time, not just when you get to retirement, but all along the retirement journey. It's no good getting to 60 or 65 and then trying to get advice, because there are various different types of pensions performing in different types of ways. Some pensions might be great pensions with guaranteed benefits, guaranteed growth rates, or guaranteed income. And some might just be very box standard pensions, not doing a great deal. So certainly advice is required at all stages, whether you're 30, 40, 60, 70, 75. Certainly advice is always going to be important around pensions. You have to bear in mind that retirement could last 25 years or more. So over the recent years, the government has been increasing the age when people could retire and receive the state pension. So previously, for men, it used to be 65. For women, it used to be 60. It then increased to 65 each for men and women. And now currently is pushing up 66, 67, 68, depending on exactly when you're due to retire. So if you work to 68 and you work and you live another 25 years, you need to make sure that you've got enough funds to cover you for those 25 years. And we need to consider, when we talk about enough funds, that you've got other types of assets that you can use in retirement. And we'll have a look at those later on. So although there's been a lot of information or a lot of change with regards to pension freedoms, pension flexibility that the governments have introduced, we would say that some things you've got to consider, you've got to be very careful, because some things may not necessarily be the best course of action for you. So here we're looking at the choices that are available. So what you're allowed to do is you're allowed to take an annuity, which gives you a fixed income for the rest of your life. You're able to take flexi access drawdown, and you're able to take UFPLS as well. So the options are, you can take one of them, you can blend all three to come up with the ideal scenario. And there are government agencies like PensionWise who can provide guidance, but unfortunately they can't provide advice or recommendations on what you should do. And of course, there's a big difference in terms of guidance and also in terms of advice. So the guidance will really say what you can do. These are your options. But where we help our clients is with regards to the actual advice in terms of your particular set of circumstances, your situation. So depending on your situation or your circumstances, some course of action might be right for you, but it might not be the right course of action for everybody. So here, what we look at is we're looking at the options available to take money from a pension scheme from the 6th of April 2015. So this is when all the pension freedoms rules came in. Now, I don't know if you can see that information. Obviously, it's quite small, but you can see that there's a number of options, a number of complexities, and it shows you all the different types of options that are available for you. What we do is we understand all of the different options and we simplify it for you to make it easy for you to make an informed decision on what you can do, what you should do, and what's going to be the right thing to do for your particular set of circumstances. So accessing your wealth, where and when. So before, the advice around pensions used to be build up your pensions during your lifetime, and then when you got to retirement around about 65 onwards, you would then use them to provide income or capital that you could use at the point of retirement. However, due to changes in tax treatments, to changes in pension freedoms, we would now say that pensions is probably more likely to be one of the last things that you should consider to access, because what happens is when you take out income from a pension, it's normally going to be taxed at your marginal rate. So this means that if you're a basic rate taxpayer, you're going to pay 20% income tax. If you're a high rate taxpayer, then you're going to pay a rate of 40%. Whereas if you're taking withdrawals from your ISA, those withdrawals, capital or income, are going to be treated as tax-free. And the other major thing about pensions, why you might want to leave your money in the pension, is because any money inside your pension is going to be free of inheritance tax at a rate of 40%. So it's not going to be subject to inheritance tax on first death. However, assets within an ISA, they will form part of your estate from an inheritance tax point of view and will be subject to inheritance tax at 40%. So this means if you've got an ISA worth £100,000 and you leave the money in there, and you've got an inheritance tax bill, i.e. your assets are over £1 million, then 40% is going to be lost from that ISA straight away. So therefore, you can clearly see why it makes sense to take the money out from ISAs first, which will be part of your estate, and leave the money in your pensions. Okay, so that's certainly an important thing to do. Now, where we come in is we provide trusted advice. Important trusted advice is so vital. So in regards to your situation, you could be saving for retirement, you could be approaching the early years of retirement, or you could be coming up to the later stages. You might be thinking of reducing your lifestyle, accessing some of the benefits. You may even be wishing or thinking about passing money onto the future generations to help them. Now, again, it means that taking advice, trusted advice, is going to be so important. So in terms of myself, I've been giving advice for a number of years. I've been advising clients since 2005. So I've been advising clients for 15, 16 years. So I've got many years of industry experience working for banks, working for myself. And the key thing for me is really making sure that we're helping families to improve or to understand their financial situation and to improve. And I've been doing seminars for a number of years. I've been doing webinars. Certainly webinars have replaced seminars since COVID started. And for me, it's just a great way to help people understand their situation and make sure that they're taking good, relevant advice to their situation, their circumstances. So we'll have a look at accumulation and decumulation. So what we know is it's important to get advice along the way, whether you're in the process of accumulating or climbing the mountain, or you're in the process of decumulating or coming down the mountain. It's important to take the right advice that will help you along the way. So let's have a look at the sort of factors that you should consider when you're preparing for your retirement. So some questions that you will be considering or should be considering will be: how much income will you need when you retire? So bearing in mind that you're going to have more time on your hands, when you have more time, you tend to be able to spend more money. So therefore, you might need a higher level of income, i.e. you might have more holidays, might spend more time with your children, your grandchildren. Certainly, you might be buying more presents. So therefore, you need to consider how much you're going to need and when you're going to retire. How will you generate that income? Where's it going to come from? Not just, it doesn't need to be just from pensions. It's looking at all assets that are available. What are the tax implications? So there are tax implications of accessing money from ISAs, ISAs or pensions. We know that. What does retirement mean for you? What is it that you want to be able to do when you get to retirement? And am I using my assets to the greatest effect? A lot of times we find that people, unfortunately, no fault of their own. It's just because we understand that people are busy with things. They're not necessarily using assets to the greatest effect. So, for example, they don't all utilize their ISA allowances. They don't all utilize their pension allowances. They certainly, for 20% taxpayers get tax relief, which we're going to. 40% taxpayers get a bit more. 45% taxpayers get a bit more. Then you've got people earning over £100,000. Again, pension contributions is a great way to recover your personal allowance, which gets reduced when your earnings are above £100,000. So it's a case of looking at all of the assets and working out what's the most efficient way to structure your assets from a retirement planning point of view. So what happens here? We look at the pillars of accumulation, the pillars of retirement planning, which are the same whether it's accumulation or decumulation. We have to understand what provision is going to be available from the government, the state. We have to understand what's available from your employer, and whether you're maximizing the employer contributions by maximizing your personal contributions, and what you should be doing as an individual to maximize tax relief as well. And again, the same will apply for decumulation. We have to look at all of these different scenarios in terms of the total retirement pots. What does retirement planning look like? Have you got a figure in mind? Very important to start with the end in mind. Have an understanding of what it is you need, how long you need this pension pot to retire for. Obviously, you have to take into account the rate of inflation, which will have a big impact on the purchasing power of your money, and that will have an impact on what sort of lifestyle you can have at the point of retirement, how far your money will last in retirement. So with a high inflation rate of 10%, which is what we have currently, that means that if you've got a value of £100,000, then in real terms, that value of £100,000 will decrease, and it's only worth £90,000 in real terms of purchasing power. So what we can see is that your purchasing power is going down, and that is going to have, if you have inflation, 10% inflation for a long time, i.e. your £100,000 becomes £90,000 from the beginning of this year till now, then next year it becomes, let's say inflation is still running at 10%, then that means your pension pot is going to be worth £80,000 in real terms. And that will have a significant impact on what you're able to do, how long you will be able to enjoy your funds, and what you'll be able to pass on to your family members later on in the future. So in terms of retirement, where people live longer, they're going to need to have increased spending for various different things. So now we'll have a look at auto-enrollment workplace pensions. So let's have a look in terms of what happened. So auto-enrollment came in a number of years ago. The key thing was that the government was concerned that people or not putting in enough money into into their pensions, and therefore they will need to rely on the government to be able to help them. So the auto enrollment ensures that both employers and employees put in contributions. If you don't know how much your employer is putting in, you should certainly find out. You should also make sure that you're maximizing contributions. So the minimum the employer has to put in at the moment is 3%, but some employers are more generous, and they put in a lot more. So sometimes you might find an employer, if you put in 6% or 8%, they will have matching contribution of 6% or 8%. So very important that you maximize employer contributions. So if your employer matches you for 6%, then you should put in the maximum of 6% into your employer pension, so that you maximize the benefit of the employer money, i.e. essentially the free money contributions. Okay. And all of this will help you in terms of your longer term plans for retirement, because your pension pot will be based on your money plus your employer money plus tax relief plus growth compounding. You add all of that together and you throw in a long time as well, i.e. because you started planning these things earlier, the better your pension pot will be, and therefore that means you'll have greater options when you come to retirement. So here it looks at your annual allowance. So currently the annual allowance is £40,000, which is the maximum you can put into a pension. Now, if you went back to 2010, 2011, the maximum you could put in was £255,000. Obviously, the governments have been reducing these figures. Then it dropped down to 50,000. Now it's dropped down to 40,000. And if your earnings are above a certain level, that means the maximum you could put into a pension would be £4,000. Now, what we have to also bear in mind is if you've got higher earnings, i.e. higher than 40,000. So let's say you've got £100,000 worth of employment income, and you haven't used up this year's allowance. You can use up this year's allowance of £40,000. Once you've done that, so once you've used up the allowance for the 22-23 tax year, you're able to go back 3 years to the 19-20, 20-21, 21-22 tax years, and also utilize those contributions where you haven't put the money. So again, that's very, very useful, very powerful tool that you can go back. Of course, you need to have the earnings. If you have if you're running your own limited company, then it's not based on your it's not because the limited company is putting the contributions in, they can actually put more money in. So that's a great thing about a limited company in terms of putting pension contributions and also reducing the level of corporation tax that you pay. So we know that the lifetime allowance in 2010 was 1.8 million, and then it's been reduced by different governments. It's been reduced, it's been changed. So right now the figure is £1,073,100. So now what we look at is intergenerational wealth planning. So what does that mean? So intergenerational wealth planning is all about thinking about passing on assets to your future generations. So for example, you could put money into a pension for your children or your grandchildren. Great thing with grandchildren is you can do it from the moment they're born. They have a allowance of £2,880, which you can put in, plus the government will put in tax relief of £720. So that brings your 2,880 to 3,600. And the good thing with making these contributions for either for your children or your grandchildren is that it matches up nicely with the annual gift exemption of £3,000. So it's a great way to utilize your annual gift exemption if you're not using it. And with these exemptions, if you don't use them fully, they get wasted. So we would always recommend you to use these allowances as much as possible, wherever possible. So with regards to children's pensions, these are the figures that you can put in. Other adults can contribute once it is set up. So the parents or the guardians must set it up. But once it's been set up, the grandparents, for example, can put money in. And the good thing with pensions is there is no access until age 55 or age 57 from the year 2028. Now, the good thing is it allows you to use your annual gift exemptions. It means that the children don't have access to this money. This money can continue to grow in a tax efficient vehicle for a long time and help to provide them with retirement benefits when they get to retirement. And the great thing is it ties up nicely with the annual gift exemption of £3,000. So again, from a grandparent's point of view, it's a great way to get that money out of the estate, and it's a great way to help their grandchildren in the future. So let's have a look at why pay into a pension. If you're a basic rate taxpayer, you pay in £80 and the government will add in £20, giving you a total of £100. If you're a high rate taxpayer, 40%, then you'll pay in £60 and the government with tax relief will give you £40. And if you're a top rate taxpayer, i.e. a 45% taxpayer, then the tax relief would be 45%. So you would put in £55, government will add in £45, and that brings it up to £100. So the great thing with this is when you're making the contributions, the tax relief will reduce the real cost, i.e. it's going to inflate the value, which therefore leads to improved performance. So let's say, for example, as a basic rate, as a high rate taxpayer, you put in £8,000. The government will put in £2,000 straight away. So your pension pot is worth 10. You'll claim back £2,000 through your self-assessment. So your pension, so it's only cost you £6,000 to get £10,000 into your pension pot. That's why pensions are very, very attractive. So let's have a look at in terms of building a retirement portfolio. Retirement portfolio does not need to be just made up of pensions. Now, it's important to consider different options because they give you different tax benefits, different flexibility, and it's useful to have these different options in the future. So, for example, you could invest money into property, which could be part of your pension in the future. Obviously, with properties and changes in interest tax relief or tax relief on interest, it's becoming more and more difficult to make money out of property. But you may wish to downsize in the future, and that would generate a lump sum which you could use towards your retirement. You could use ISAs because they're a great vehicle. You've got access to them. They're very straightforward. You may be expecting an inheritance from a family member. Of course, you should consider pensions as part of good retirement planning. You could invest in stocks and shares. You'll get your state pension. Now, what I would say is if you haven't made enough national contributions to get the pension, you might wish to consider making more national insurance to maximize your pension. And then you've got some other things like LISA and equity release as well. So when we come to retirement, again, there's be some questions in terms of income and capital that you're going to need. So how much capital are you going to need? And then how much income will you need on a day-by-day basis to allow you to enjoy your retirement? How and when should you access my accumulated savings? So we've already said that if you've got money in ISAs, you've got money in cash, you're worried about inheritance tax, then we would recommend taking that money out first before accessing pension benefits. Pension benefits should be one of the last things you access. What are the tax implications? So we need to understand the tax implications. What are my options in retirement? And what other considerations are now a priority? So there's a whole range of things. We need to consider your objectives, what you can do, what you should do, and therefore it's again very important to understand all of these options. So again, this is just talking about the options. State pension, you should is paid in addition to your own pension. It's treated as taxable income. So any income you receive from pensions is taxable unless your income is within the personal allowance, in which case pensions will not be taxable. It's part of your retirement plan. It's subject to eligibility. Maximum rate is currently £9,627 per annum. And if you're not sure how much is your state pension forecast, you can get a BR19 forecast, which will tell you what your value would be. So what is pension freedom? So in simple ways, in simple terms, there's three options which we've described so far. You can take one of them, or you can take a lot of them. Now, annuities seem to have fallen a bit out of favor in recent times, and that's mainly due to low gilt yields, interest rates, and all of these things have led to lower annuity income. Now, the thing is, once you take an annuity, it's fixed, you can't change it. So if you take it and the interest rates then go up, you're then locked in at low rates. Now, with annuity, there are certain scenarios where it could be very useful. So for example, if you need a fixed amount of income, then annuity would be a very good option. If you also need to be able to provide some money for a spouse, then annuity could be an option. Now, what a lot of people don't do is when they get their annuity paperwork from the scheme provider, they don't necessarily look at the options available on the open market value. Now, a lot of times they will just accept the quote from the provider, whereas there could be better options available on the open market, and that could be worth several thousands of pounds over the course of time. And then you've got Flexi Access Drawdown, which allows you to do various things within the pension. It allows you to take out a percentage of your 25% tax-free cash. It allows you to take out all of your tax-free cash, 25% should you wish to. It allows you to access drawdown benefits. And you've also got uncrystallized fund pension lump sum. So what happens here is you take every time you take a payment, 75%, 25% would be treated as tax-free, and then 75% would be treated as taxable income. So moving on to leaving your pension pot. So as we've said previously, with pensions, this is money that you could leave to your spouse free of inheritance tax, and it can be used to provide them with a tax-efficient lump sum or an income. However, the death rules are complex around pensions, so therefore it's important to take advice, how they impact you, and what you can do, what you should do. So the great thing with pensions is that they can pass on to family members. They can go from generation to generation. Previously, that was not the case. Previously, you'd be able to provide a spouse pension, or you'd be able to take some tax-free cash, and the balance would be as income. So we can certainly put it into a trust to protect it from inheritance tax and other risks as well. So let's have a look at the future. Nobody can predict the future. The future is uncertain. The future is unclear. Nobody knows what will happen to you, when it will happen, and to your loved ones as well. So we need a flexible retirement strategy. Vital, absolutely vital. So we know that the reasons for better increased life expectancy is that there's better survival rates. So we know that people are more aware of smoking, they're more health conscious, they exercise, they diet, so all of these things help. There's been a lot of medical interventions, medical improvements, which have helped to detect illnesses earlier and lead to better treatment outcomes as well. And also healthy diet and lifestyle. So a lot more people are more health and diet conscious. And so these are all things that are leading to increased life expectancy. Plus, with hospitals and changes in medical science, they're able to pick up these things earlier, detect them. So therefore, there's a better chance of dealing with these things. So in terms of retirement, we know that we're looking at having different types of asset classes, different types of income. So certainly there should be pensions, there should be investments, maybe property, maybe reduced down to part-time work. So what we're saying is having all of these options will allow you to maximize the benefits, go for the combination of options that will be most beneficial for you, for your retirement. Sorry, just 1 second. I'm just going to get a quick glass of water. Excuse me, 1 second. Thank you. My apologies. I just got a little bit thirsty because I've been talking for a long time. So how should I be invested? So we should be looking at the different asset classes. So this would be cash, property, equities, and fixed income. So it's important to understand where to invest, how to invest, different amounts in different asset classes. And you don't want to put all of your eggs in one basket. So it makes sense to invest into different asset classes. So the reason why you'll always hold cash is because of liquidity, just in case of emergencies, or you just want to have some access to money. Having some cash available is always good. Property. So for example, your main residence is an asset which you could do something with later on in the future. You could have buy-to-let properties, you could have commercial properties. Again, it's giving you more diversification within property asset class. You could invest in funds that invest into property as well. You can invest in equity, so putting your money in the stock market, getting access to different large companies like Apple, Microsoft, Amazon, Facebook, Bank of New York, or Bank of America, and then you've got fixed income, fixed interest, where you could be investing into corporate bonds or government gilts as well. So again, where you invest, how you invest will depend on your goals and your objectives, and how long you've got to go until retirement. So here, what we do at St. James's Place, we have different portfolios that can help you with regards to your requirements. They can be focused on growth, or they can be focused on income. So here we're looking at the global investment management expertise. So at St. James's Place, we look far and wide for the fund managers. We look across the globe to attract the best fund managers. And the key thing today is we want to make sure that your portfolio is growing. So how it works is St. James's Place will control the mandate. We select the managers. We set the mandate, and they have to do what's required by the mandate. If they don't follow the mandate as they should be, then we can replace them and bring in different managers, and they would come in on a slightly different mandate. So at St. James's Place, our approach is based on selecting the fund managers. So we'll do research. We'll have interviews with fund managers. We'll analyze them. We'll appoint them. We'll monitor the fund managers once they're managing money, and this is done on a regular basis. And we'll also change it, because sometimes some funds will be good, but they may not be so good in the future. Things could change in terms of the type of style that's common. Certainly that all makes a difference. And from our point of view, it's about making sure we have the right fund managers managing the right funds. We want to make sure that we monitor them in terms of the output they're generating, in terms of the mandate we're given, and we're able to change them accordingly as and when required. So we know that the need for financial planning, tailored financial planning and access to a robust and effective investment strategy has never been higher. So what we want to help you to do is create a plan. The plan will understand your situation. There'll be advice from experienced professionals in terms of your overall planning, and it allows you to achieve better outcomes for your retirement. So we'll have a look at facts of life. So almost everyone has to save more for their retirement. So this goes back to what I said previously. If you can maximize employer contribution, maximize your contributions to maximize the employer contributions, you should certainly do that. If you don't accumulate enough, you run the risk of outliving your savings. So that's a very real scenario where people haven't built up sufficient pots, they live for a long time, and therefore they end up reducing their pension pots quite considerably. You have to consider the life you want to lead in retirement, determine how much you will need to save. So you work backwards, you work out how much you need to get to that figure. Then this is the amount you should be investing on a monthly basis, and doing that throughout the time to retirement. And you should commit to a plan and take action. So now what we talk about is the importance of reviewing things. So we know in the future that circumstances will change, taxation, budgets and allowances will change as well. So we need to make sure that your planning is on track and is running in the correct way to maximize these benefits. We know that clients' situation will change and economic conditions will change as well. So right now, like the factors I mentioned at the beginning, investments have gone through a tough time, and that's where experienced financial advisors can help. We don't expect this situation to stay like this forever. We expect the markets to recover at some point whenever they're ready to do so. And when they recover, we'd expect some of these companies, some of the funds to go up quite nicely in value as well. So from our point of view, the key thing is we understand the client requirements, we understand the taxation, so we try and keep things as simple as possible for the clients so that they can fully appreciate and understand the area of retirement planning. So that brings me to the end of the presentation slides. Thank you for listening and taking the time this evening to join us for the webinar. And now we're ready for some questions and answers. So hopefully you've got some questions from the presentation so far.
Thank you, Dipesh Bhai. Yes, if anybody has got any questions, if you just unmute yourself. Questions, Dipesh Bhai ne pucho. I've got one on the chat, Dipesh Bhai. Do you think the financial markets will improve?
Yes, I would expect the financial markets to improve. We can't be exactly sure when they're going to improve. It might be 9 months, it could be 18 months. What we do know is that the central governments have been increasing interest rates to bring down inflation. So what happens is they've been pushing up the interest rates, and the idea is as you increase interest rates, that will bring down inflation. So one of the key things that they need to do is get inflation under control. So how the markets work is they work in a slightly different way because they're dealing with data in real time. So if the data comes out favorable, or it shows that the inflation is not as bad, or we're on track to recover sooner than expected, then the market will go up. Conversely, if the opposite happens, then the market will not like it, and the market will go down. Now, in terms of some of the things that are happening in the world right now, in terms of the things that we've seen so far, for me, I've been investing since 1995. Okay, I've been investing funds, and I always think there's been a number of crises that's happened over the years. 2001, there was the Twin Towers in America that went down. Obviously, the markets went down. Eventually, they recovered. 2008, we had the financial crisis that affected the global economy, and that lasted for a few years, and then the markets recovered. Then we've had things like China slowdown, America losing its AAA credit rating. We've had COVID. We've had slowdown in China. We've had all of these things. We've had wars, tsunamis, all of these things which have had an impact on funds. So again, it's very important that you have a diversified portfolio. You take advice on your pensions, because otherwise these factors, if you don't know where you invested, how you invested, could actually have a significant impact, i.e. they could derail your plans for retirement. So certainly we do expect it to recover. This year has been a storm where everything has just gone down. Doesn't matter really what you've invested in, the majority of asset classes have been down. So yeah, we would recover it. We would expect the markets to recover. We just can't say when.
It's a difficult time for everybody, isn't it? And, you can see it in the news, can't you? In the world, well, the UK, the worldwide, isn't it?
Absolutely, but sometimes the problem with the news is they make things more dramatic, more worse than it is. That's certainly a problem with the way the media reports the bad news.
Another question from, or a statement from Chambakbai, that yes, the market will improve. However, what happens if someone reaches retirement age in the next couple of months? Because you're aware that there has been a dip in the market. So what would your...
So normally what would happen is as you get closer to retirement, it's important to understand the level of risk that you're happy to take. Now, if you have sufficient assets in the background, you could be comfortable with taking a higher level of risk. Whereas if you've got less substantial assets, less other assets that you could survive on, and your pension is going to be a major part of your retirement planning, then you may not be wanting or willing to take so much risk as well. So it's a case of maybe moving some of the money into different types of asset classes, making sure you've got diversification, thinking if you've got other assets and if you can leave your pension fund, then that could be a scenario. So certainly you'd have to just consider different options, different types of asset classes. Certainly that would be the way to go there.
Okay, thank you. A question from Saben. Can you still add to your pot if you have already reached the retirement age and still working part-time?
Yes, absolutely. So even if you've retired, you can still add money to your pension pot. Even if you've retired and you've got no employment income, let's say you get you can put in £2,880 into your pension, and the government will add £720 tax-free. So that would give you £3,600 into your pension. So yes, you can still contribute. The maximum age you can contribute to a pension is 75. You'd be eligible for tax relief as well. So certainly where you're still working and you've got excess capital, or you've got an inheritance tax problem, then putting money into your pensions is a great idea.
Any other questions, or unmute yourself?
I think there's a few more questions in the chat. Is there, or?
Sorry, yes, yeah. So from Musha and Vicky Bhai, is it safe to move away from company's final salary pension scheme and move to another provider? As in my case, I will receive less from my pension as it includes spouse and I am widowed.
So with the final salaries, the great thing with them is they give you a lot of guarantees, i.e. The value doesn't go up and down. The value of the income you'll receive will increase in line with inflation, so that's good. But the downside is it won't allow you to pass any money on to your family members. So when you pass away, your pension pot will end with you. There's no way of passing it on unless you've got young children, young dependents under the age of 23, then the money can go to them. But if your children are older, then that pension money won't go to them, especially if there's no spouse. So if you've got enough other assets, then it could be an option, but it's something we have to look at in a great amount of detail because of the complexity involved with final salaries. And then we would tell you, we would advise you if it's the right thing for you to do, or maybe it's not the right thing for you to do. So
how do I contact you, Bhai?
So I'm not sure if you can see my contact details. So my name Dipesh Shah, my company Oakdale Financial Services. My contact details are there. Feel free to contact me by telephone or by email. Email is dipesh.shah@sjpp.co.uk.
Okay. If the contact details are there, then I will find it. Thank you.
Yeah, the contact details are here on this slide.
Or then just contact Samaj best.
Contact, yeah.
Yeah, and we'll pass it on to you if you can't take that. Hey, can you see the screen, Ben? Can you see?
Yes, I can. Yeah.
Yeah, just if you're on the computer, if you just take your phone out and probably just take a photo of it, would be the easiest way to do it, I think.
Take a photo of the screen. Yeah.
Yeah.
Okay.
Yeah.
Yeah.
The number and thingy, so, okay.
Okay. Thank you very much.
Yeah, no problem. Sorry, a few more questions from Mahendra and Bhati. What's the maximum income a pensioner has before paying any tax?
So you have a personal allowance of 12,500. So not just pension income, but across all income, you can earn 12,500 without paying any tax. Anything over 12,500 will then be subject to basic rate tax of 20%.
From Chandrabai, is it possible to put the proceeds of a sale of an investment into a pension pot to reduce the tax liability?
So depending on your level of earnings, because remember, it's always linked to earnings. So with pensions, they're very clear. Earnings, we're talking about salary income. We're not talking about rental income. So it's got to be your salary or employment income, not dividend income. It has to be. So if you've got income and you've got unused allowances, if you've got unused allowances, you can use that money and benefit from the tax reliefs of a pension. So you'd get income tax relief. There's no capital gains tax. There's no inheritance tax. But the key thing is you've got to have the earnings to be able to do so.
Thank you. Question from Ansabel again. Can you explain what LISA is and is it still available?
So lifetime ISA is still available. I believe the age is maximum age is 40, and it allows you to build up money into an ISA, which can be used to buy a property, or it could be used as part of your retirement funds when you get to retirement.
So people up to age of 40.
Correct.
Okay. Question from Champabai. If you have 100,000, I think it's 100,000 pot after 25% tax-free, what would be pension each month?
So if you got a pension pot of £100,000, you would take out your 25% tax-free cash in this scenario. So that leaves you £75,000, which you could either invest into an annuity, which will give you a fixed amount of income, but will die with you when you pass away, Or you could look at flexi access income, which allows you to control how much you take. So you can take as much or as little as you need. Whereas an annuity, there's no flexibility. The amount is the same all the time. You can't increase the amount or decrease the amount once you take annuity. So it depends on your circumstances, what other income streams are available, and how much you need. So there are ways of taking more. Obviously, you've got to pay more tax, or you could take less if you don't need so much and pay less tax overall.
So you could take 25% lump sum, and then the 75 you could take 1,000 a year or 2,000 a year.
You could take £1,000 a year, or if you needed the whole amount, although it's probably not good advice, you could take out, the rules will allow you to take out £75,000, but then you would pay interest. You'd pay income tax at 20% and 40% as well, and possibly 45% if your income falls into the top bracket. So there's different things that we need to consider, but certainly you control how much you need. If you don't need to take out large amounts, then you take out small amounts and you leave the rest of the money to continue to grow in a pension, which is going to be one of the most tax efficient vehicles out there for you.
Yeah, so anything under 12,500 you could take tax-free out anyway each year. As your
correct. And you could also you could structure in a way that you just take out your tax-free income, your tax-free allowances, so you're not wasting them.
Okay, I think that was it. Yeah. Dipesh, have you had a question previously? Could you, as you get older, you potentially don't go on many holidays and so forth, so you would potentially want to use money more in your, if you say retiring in your 50s or 60s and stuff, than in your 80s and 90s. Have you dealt with that and stuff, and you can structure it that way? So
what used to happen a long time ago, before the rules changed, when people got to 55, they had the option of taking the annuity income. The idea is that you have the benefit for the longest. If you take it at the earliest possible stage, then you've got the income for as long as you live. But what we've been finding in more recent times is that because people are in good health, so nowadays the 80-year-olds we see today, they seem better health-wise than the 80-year-olds that I used to see maybe 10 years ago. And this is all to do with better lifestyle, better nutrition, more exercise. People have more awareness of health and fitness, nutrition. There's lots of places you can go. People are looking after themselves more. So where we see it is people are they're still able to enjoy themselves at 70. Nowadays we don't really see 70 as old. There's lots of 70-year-olds still doing plenty of things. There's lots of 70-year-olds still driving, 75, 80-year-olds still driving. So not always going to be best just to take the money out as early as possible, but then it depends on what your situation is. If you've got no one else to worry about, or no kids, or your children are well off or don't need the money, then you might think, yeah, I'm going to spend the money. But it all depends. You might also say, well, we can actually not, if we don't spend the money like you're saying, then the money could just stay in the pension, and then it can pass free of inheritance tax to the children. So there's different things to take into consideration, certainly.
A question from Balabai Hansaben: how do you charge your fees?
So when we have a first meeting, there's no charge for the meeting. So at the first meeting, it gives you a lot of information about how the charges are, depending on what type of work you'd want us to do. Now, obviously, we can go through that in detail with you in a meeting. Of course, there's no obligation with a meeting. The purpose of today is really to share some information, to give you some thinking points, or really things to consider, because these are things that I deal with on a day-to-day basis for a lot of my clients, but a lot of times I know with clients, I know people are busy. They don't always get time to look at these things. Life happens, things happen. You want to look at it, you want to do it, but you never find that, unfortunately, with life, sometimes there's never a right opportunity for these things. You just, even like, for example, wills. So many people don't have a will, and really important that you take time out and consider these things and consider the impact on yourselves, your family, your wealth. Take the time, take the advice, understand what it means for you, for your circumstances, and we try and do it in a easy to understand way. We don't complicate things, because this industry is already very complicated with jargon, terminology, jargon, terminology, and paperwork, literature. It's never that straightforward, so we try and keep it as easy as possible for you.
Okay. Thank you. Any other questions? Yes. Okay. Thank you, Dipesh Bhai. I think, Joe, if anybody wants to contact Dipesh Bhai, then the number is there. Just take a screenshot or a photo with your camera, or you can contact me or Dipesh Bhai, our SBA UK secretary, and we can put you in touch with Dipesh Bhai as well. Okay. One last question. How would you, from Manish Bhai, how would you suggest to invest lump sum? So we'll take that as the last question, Dipesh Bhai, and then we'll wrap up.
How would you say to invest a lump sum? So you've got the starting point would be certainly looking at a pension, look at an ISA, might be a combination of the two. Make sure that you've got enough liquid funds available for any emergencies. So again, it's going to depend on what income you have, what allowances you have, whether you need access to the money. If you need access to the money earlier, then an ISA may be more suitable. If you think I don't need access to this money for a long period of time, then it's going to be a retirement account. If you're trying to do inheritance tax planning, then again, there might be some different options. So from our point of view, we would need to understand your situation fully. Once we understand the situation, we can then say, look, these are the different choices of investment that will be suitable for you to meet your objectives. So there's lots of different ways that you can invest a lump sum, and there's different vehicles, different tax benefits, tax situation. We have to consider the full picture.
Okay. And I think the last one from Ansama, I think you may have answered this already. If anybody wants to go with SJP, is there a monthly or annual admin charge?
Is there a monthly or annual charge? So there'll be charges for investments. All firms in the industry will charge a cost for managing the funds.
Okay. Last question. That's no worries. Should I focus from Manish? Should I focus on paying off the mortgage, as it will be part of my estate?
So paying off your mortgage, I mean, it's an interesting one, certainly, because right now interest rates have been going up. So depends whether you're on a fixed rate. If you're on a fixed rate deal, then your interest rate will not be changing. But if you're on a variable rate, then that means your mortgage payments, your mortgage payments will increase. And if the amount of money, if the rate is higher than the rate of return you can get on investments, then it may make sense to pay off the mortgage. But from a inheritance tax point of view, it won't make any difference. If you have £100,000 in your bank account and you've got a mortgage of £100,000, if you pay off your mortgage, then you won't have the £100,000 mortgage, and you also won't have the £100,000 cash. So from an inheritance tax point of view, it certainly won't make any difference paying off your mortgage. So again, it's something we'd need to look at in more detail, because there'll be a range of factors like I've just highlighted so far.
Okay, thank you. I think that's it. Thank you, Dipesh Bhai. We have got another seminar. Dipesh Bhai is going to join us again in February, I think, now for ahead of the tax year end, and we will do something on tax planning there.
I think it was January.
Was it January? Okay, we'll send out a flyer and yeah, get a flyer out to everybody as well. So thank you. Again, if you got a question, let us know, or contact your own SBA branch, and they can pass it on to us as well. Okay, feedback or please let us know as well. It's just nice to hear feedback on this seminar, other seminars we do as well, so we can help put things on and improve as we go along. Dipesh Bhai, would you like to say anything before we hand over? We close down.
I think you can.
Okay, thank you. Namaste and Jai Shri Krishna, everybody. Keep safe, keep warm, and take care.
Brilliant. Thanks very much, Kamlesh and SBA.
Dipesh Bhai.
Hello, hi, Jasubin. How are you?
Good, thanks.
Good.
Thanks.